Hey everybody, welcome back to the channel, and today we're going to be talking about my trading philosophy. So this is one of the first pages of this book I'm working on. It's called How to Trade Anything. I'm hoping to have it out by the end of the year. What I really want to talk about is kind of, the 6 things that I believe are true within the market. So number 1, the market moves in 4 stages. Number 2, the direction of the trend will continue until it stops. Number 3, the market is never wrong. Number 4, the market discounts future events. Number 5, no one trade can ever bankrupt you. And number 6, no trading strategy is infallible. So we'll kind of, refer to this list throughout this video, but let's start on number 1. So the market moves in 4 stages. So if you've seen it in my previous videos, I put out a series on Stan Weinstein's version of stage analysis and kind of threw in a couple of my own, little tidbits and interpretations of his work. And that's really where my fundamental philosophy of how markets move comes from, is that they move in 4 stages. So here's a chart of Peloton. I use this one a lot because it just is so great at showing the 4 stages. So here's our stage 1. That's our kind of accumulation center. Back in late 2019, early 2020, we formed the stage 1 base, and then in mid 2020 we broke out, and that's where we got this big stage 2. And then up until the end of 2020, we kept going higher and higher, and that stage 2 is defined as a series of higher highs and higher lows. So we finally put in our highest high here, and then we started to see this stage 3 form. And that's where you start to get more of a sideways consolidation pattern. And up on top, the stage 3 is called distribution. And then as time progresses, we continue to chop around in this stage 3 area. And then finally, we get this huge bar down, and that's our stage 4. And that's where we've been ever since. So that's my kind of fundamental theory as far as how markets move. They move in those 4 stages. And, I didn't really cover this in those previous videos, but just to let you know, a stage 2 does not always have to be succeeded by a stage 3. It could turn from a stage 3 into a stage 1 and continue to go higher. And, kind of the inverse of that, a stage 4 does not always have to be succeeded by a stage 1 into a stage 2. It could go from a stage 1 or a stage 4 to a stage 1 back to a stage 4. So you just kind of need to, see what the chart's telling you. The reason I love the 4 stages of price movement so much is because it's not really about guessing where price is going to go. I mean, obviously we always have to have a bias, and that's how we kind of place our trades, but if we see something change, we don't have to, continue to trade it that way. We can change very quickly, and our interpretation of where we think price is going to go can change very quickly as well. So that's why I love the 4 stages of price movement. Next up, we have the direction of the trend will continue until it stops. This is kind of, the second level of stage analysis. You always have to assume a stage will continue until it doesn't. So, we're in this stage 4 on Peloton, and I have no reason to believe that we aren't in stage 4. I have seen no indication that the trend has changed. If we put on this moving average, the moving average is still straight down, so that gives me even more inclination to believe that this stage 4 just continues to, power through. Even if we saw price go from $9 to $14.50, I'd still say, hey, this is a stage 4, just because that moving average is straight down, and you need time to have these stages develop. You need time to see, one stage go into another. So that's why I always believe that if price is going down, it's going to continue to go down. If price is going up, it's going to continue to go up. And if price is going sideways, it's going to continue to go sideways. And just by believing this, I don't have to guess. I don't have to try to predict where the market may be. I simply trade what the market is telling me, and I'll control my risk from that aspect. So next up, the market is never wrong. And that's where it goes to, you don't need to predict. You don't need to kind of, give your preconceived notions of what you think the market is going to do and try to impose those on the market. The market's never wrong. It's never, doing the wrong thing. It's always doing exactly what it should be because the market is always right. You don't want to fight the market. You can never buy so much of a stock or of a crypto or anything else that it'll just magically go up and you'll be the reason that it trades higher. You have nowhere near the size to do that, and almost no one on earth could be able to, coordinate a move like that. I don't even think if all of the mutual funds got together, which would never happen, maybe they could move it, but one individual person, even one large institution, is never going to be able to impose their will on the market. So that's why the market's always right. You're always wrong if the market is not living up to your bias. So next up we have the market discounts future events. So let's go look at a chart of oil now. We'll drop down to a lower time frame. So as you can see here, everyone remembers we had this big, huge run-up, and then, coming out in December of 21, and then into, kind of this climax of March of 22. So this is when Russia invaded Ukraine. They did it right at the end of February, and that's when we got this real high move up. But, before that, oil had been going up for, 3 months prior. And that's where participants want to, front run these kind of headline events. If something's coming in the headlines, there's a very good chance that you have already missed the move, whether it be up or down. We're dealing with the smartest people in the world when it comes to trading assets, and they always have information that you don't have. So that's why it's paramount to just study charts, see exactly what price has been doing, and don't listen to what's going on in the news. Don't listen to what you're seeing on social media. All of it is probably bullshit. You need to just trust your charts and realize that if something is making big headlines, it's probably already been priced in. We're going through earnings season right now. Obviously, you get those big moves after hours, and that happens 4 times a year with publicly traded equities. And a lot of the time, that's kind of determined based on the guidance that the actual company gives. So, maybe you could trade that just because that news is kind of unknown. But oftentimes, you'll see those moves after hours or pre-market in the direction of the predominant trend. So let's see who reported today. I know Texas Instruments traded. So they reported a while ago. I think it might have even been this morning. And for the past month, it's been going straight up. So that kind of lets you know that, all these smart individuals were kind of front-running this trade because they knew that Texas Instruments was going to be reporting a good earnings report. So that's why, even though we did get this move higher, it has been going up for a substantial amount of time. And that's how you know that, more or less the market does effectively discount everything. Next up, we have no one trade can ever bankrupt you. So the only way that you can possibly continue to trade is you have to have money. If you blow out, then there's no way for you to continue to keep trading. So what I usually do is I have these rules. I never let more than one industry or sector be more than 25% of my total trading account. So like, for instance, I'm long oil at the moment through AR and EQT. And I have, pretty large positions of both. I think AR is 10% of my account, and then EQT is 15% of my account. And I keep, decently tight stops on those. I use one ATR offset, and with those kind of volatile assets, usually the one ATR offset is right around anywhere from 8% to 10%. But even if I was completely wrong, even if they gap down huge and they close down 50%, I'd still only be down 12.5% in my account on total, and that's something that I can kind of live with. I'm not going to be happy about it. It's going to hurt, but I'm not going to be, blown out. I'll still be able to wake up tomorrow, and I'll still be able to place trades. And that's why you have to practice risk management. You don't want to get over leveraged. If you're trading options, you don't want to put 100% of your account into one options trade. That's just absolutely idiotic. Obviously the payout would be huge, but the risk reward just isn't there. Even if you make, even if you risk $1,000 and you make $1 million, but it was your last $1,000, it's not worth the risk of absolutely bankrupting yourself. So that's why you have to position yourself carefully and never use a stop loss or a position size that's going to absolutely blow you out if you're wrong. Because from our next point, no trading strategy is infallible, you're going to be wrong a lot. This has been a tough year for a lot of people, with the indices down over 20% at some points. Often, as traders, we're trading more volatile assets than the indices themselves. So a lot of people probably saw drawdowns of 40 to 50% this year, and we're only 7 months into the year. We still have 5 more months to go. So that's why it's crucial to always practice risk management, and it's crucial to always remember that no trading strategy is infallible. You're going to go through periods of rough times. So just kind of looking at some of my average returns for each of these months. So I placed 34 trades this year, and I'm batting less than 300. So less than 30% of my trades have been winning. But I'm only down right around 4%. And I do this through cutting my losses short. That's how I'm able to, have this small drawdown compared to the actual S&P or Qs. And I'm also doing this in a very short amount of time. So these are calendar days, and I've been cutting my average trade at around 8.5 calendar days. So even with this super low batting average, even with a pretty large loss percentage, if you talk to a guy kind of like Mark Minervini, he really wants to keep his trades right around a 5% loss. And I'm doing, negative 7.7% and less than a 30% batting average, and I'm still, right around this negative 4% on the year. So that's why, you always have to position yourself correctly, you always have to size yourself correctly, and you want to cut your losses short, just because no trading strategy is always going to work. So that's kind of just, a brief overview of my trading philosophy. Obviously, I could go more in depth on those, and I probably will in future videos. So keep watching and, enjoy the rest of your night. Thank you.